For this whole series, we have kept two worlds apart. The value world, where you study a business and ask what it is truly worth, and the technical world, where you read the chart and ask what the price is doing. Today, Micha fuses them into a single method, his own approach to valuation, and it is one of the most practical ideas in the entire course. Let's learn how he marries value and the chart. First, let's record the heart of value investing in one clean idea. Every company has an intrinsic value, an estimate of what the business is actually worth, based on its earnings, its growth, its assets. And separately, it has a market price, whatever the crowd happens to be paying for it today. The two are not the same. Fear and greed constantly push the price above or below the real value. The entire goal of a value investor is captured in one sentence: by when the price is meaningfully below the intrinsic value. When a wonderful business goes on sale, trading well under what it is truly worth, you buy that gap. That cushion between the low price you pay and the higher value you believe in is the famous margin of safety, the bedrock idea of Benjamin Graham and Warren Buffett. But here is the problem with pure value investing, the one that drives people crazy. Being right about value is not enough, because being cheap is not the same as going up. A stock can be deeply undervalued and simply stay that way for years, dead money, while you wait and wait. This is the dreaded value trap. Or worse, it can be cheap and keep falling, the fallen knife we just met. Value tells you what is worth owning, but it is silent on when. And that silence is exactly the hole Micha fills by bringing in the chart. His method does not throw away the fundamentals. It adds a second filter on top of them. After he finds a business that is genuinely cheap on value, he turns to technical analysis and especially to moving averages to answer the missing question. Is the market actually starting to wake up to this value yet? Here is the logic, and it is beautiful in its simplicity. A great undervalued company whose chart is still falling is a knife. Leave it alone. But a great undervalued company whose price has stopped falling and has started to reclaim its moving averages to ride above them and turn up is a value stock that the smart money is finally beginning to accumulate. The fundamentals say it is worth owning. The chart now says it is finally safe to own. So picture the full method as two gates the stock must pass through. Gate 1 is value. Is this business trading below a reasonable estimate of its intrinsic worth? If no, you pass. Gate 2 is the chart. Is the price confirming, holding above, or reclaiming its key moving averages, showing the turn has begun? Only a stock that passes both gates, cheap and confirming, earns your money. You are buying value, but with the wind of momentum finally at your back. This elegantly solves both of the classic traps at once. It saves you from the pure technical trader who chases an expensive, exciting chart attached to a garbage business. And it saves you from the pure value investor who buys a cheap business and then bleeds for 3 years in a value trap or a falling knife. By demanding both, you only commit when the company is good and the timing is right. A quick, honest word on estimating intrinsic value, because beginners think it is precise. It is not. It is an educated estimate built from earnings, growth expectations, and simple valuation multiples, and reasonable people will land on different numbers for the same company. That is fine. You're not seeking a perfect figure. You're seeking a clear margin of safety, a price so far below your rough estimate of value that you do not need to be exactly right to do well. And our steady honesty closes the loop, as always. Even a beautiful method that fuses value and the chart only stacks the odds, it never removes risk, because every estimate of value can be wrong and every chart can fail. And the calm long-term index investor, of course, values no single company at all. They buy the entire market, trusting that the whole thing in aggregate compounds upward over decades. No valuation math required. So here is Micha's method in one breath. Find a good business trading below its intrinsic value. That is your margin of safety. Then wait for the chart, the moving averages, to confirm the market is starting to agree. That is your timing. Value tells you what to buy, the chart tells you when, and demanding both is how you sidestep the value trap and the falling knife in a single, disciplined move. I'll see you in the next one, where we dig into the secrets and your questions about this very method. Until then, keep it simple and buy good things at good prices at the right time.